On this video, we're going to be looking at indirect taxes. There are two types of tax. Direct tax is placed directly on someone's income or wealth, and indirect tax is based on their spending. A good example of a direct tax is income tax. So if income tax comes down, that means that people have got a bit more money in their pockets, which means for normal goods, demand will rise, and for inferior goods, demand will fall. So it affects the demand curve. We are not interested in direct taxes in this video. Now, an indirect tax is placed on sale. So if a supplier sells a good, they must pay a certain amount of it to the government. So it's just like any other cost. They have to pay wages, they have to pay for materials, they also have to pay indirect taxes. So if an indirect tax goes up, it's the same as a cost going up, which will shift the supply curve. They're obviously going to try to recoup money back from the consumer if they can, but essentially it's a supplier that has to pay it to the government. There are two types of indirect tax. Specific taxes are a sum of money. So if you buy a litre of petrol, then around about 60p of what you pay for that petrol will be paid in tax to the government in petrol duty. By contrast, an ad valorem tax is a percentage tax. So for example, at the moment, the rate of VAT is 20%. So if the firm is selling, say, a Mars bar that costs 50p and VAT is applied on it, then the extra tax will be 10p, which is 20% of 50p. If they are selling a car that costs £50,000, then the VAT will be £10,000. So it isn't dependent upon the number of units that you sell, it's dependent upon the price of those units. So first of all, let's look at specific taxes. We're going to be looking at this market that you can see on the left hand side. You can see this market is in equilibrium if the price is £100, because at that price the market clears with demand at 22,000 and supply at 22,000. But the government wishes to impose a specific tax of £30 on every unit that is sold. Now you can see the impact of that. So if, for example, the firm wants to sell 6,000 units at a price of £60, then the price that the consumer will be paying will have to be £90 for that 6,000 units to be produced. Because if the consumer pays £90, then that means that the producer receives £60, and the supply curve tells you that at that price they are prepared to supply 6,000 units. So if the price goes up to £90, then the supplier will be supplying 6,000 units. So basically we are adjusting that supply curve down to deal with the tax. And you can see here that we have shifted the entire supply curve by £30 a unit. Now let's take a look at what has happened here. Well, if you look at the original price of £100, buyers still want to buy 22,000 units, but suppliers are only prepared to supply 10,000 units, so we haven't got an equilibrium. However, if we add on that £30, then the price is going to be £130. Now, if we look at the supply at £130, it's 22,000 units, but demand is only 16,000. However, if we look at that price of £120, £20 above the original, you'll see that the market clears because demand is 18,000 units and so is supply. So £120 is the new equilibrium price. So as far as the consumer is concerned, the price has risen by £20. So that is the consumer burden per unit, or the consumer incidence per unit. But let's look at the supplier. Well, the price is £120, but they've got to give £30 of that to the government. So as far as the producer is concerned, the price has fallen from £100 down to 90. So the producer incidence is £10 per unit. Now remember now that 18,000 units are being shifted, and on those 18,000 units the government is taking £30. So in total the government is going to get £540,000 from this to spend on health or education or invading another country or whatever the government wishes to do. So how's that 540,000 made up? Well, remember the consumer's price has increased by £20. So there are 18,000 units being sold. Consumer is effectively paying £20 of the tax to the government. So the consumer incidence is £360,000. For the producer, the amount that they're receiving has gone down by £10 on each of the 18,000 units. So the producer incidence is £180,000. So of the 540k, the consumer is paying 360k and the producer is paying 180k. Well, we're going to want to draw a general diagram in a question. So we start with your standard market equilibrium. We then impose the tax. Now you can recognize a specific tax because the new line is parallel with the existing line. It's going to be, on my example before, £30 higher than the original line. Now that leads to a new equilibrium price. The price has increased from P to PT. Remember that was £100 to £120 on our example, but the quantity has fallen from Q to QT. Remember it was 22,000 and it's fallen to 18,000. But the green line shows what the producer receives from it, and you'll notice there the amount that the producer receives, PP, has fallen from the original price. Again, on my example before, it's fallen from £100 to £90 a unit. So the total tax take for the government is that yellow area. Remember that was 540,000 quid on my original example. And of that pinkish rectangle shows the consumer burden and the green rectangle shows the producer burden. Now, depending upon how you draw the diagram, sometimes the producer burden is bigger than the consumer burden, depends entirely on elasticity of demand. However, the quantity that's being sold has actually fallen. If you remember, that's fallen from 22,000 down to 18,000. So those 4,000 units can't be given a surplus to producers. They can't be given a surplus to consumers. They can't be given anything to the government. So that is completely lost, and that is the economic cost, the welfare loss to the economy as a whole. You'll find that welfare losses are often triangles for some strange reason in economics. So that yellow area there is surplus that's completely disappeared because those units are not being produced. But what about the impact of elasticity? Remember, that was one of the things that the spec was looking for. So this diagram here is exactly the same one as we had before, except now I've got a more elastic demand curve. You can see there the welfare loss is a lot higher, the producer burden is higher, but the consumer burden is lower. You'll notice that the quantity being traded goes down quite a lot from Q down to QT. So with an elastic demand curve, the burden is more on the producer. Now, if we think about the types of goods that actually have specific taxes imposed upon them, cigarettes, petrol, booze of various types, you'll notice that they are inelastic in demand. So if the tax goes on, it's going to be the consumer that bears most of the burden. Quantity doesn't fall by that much, and that means that jobs, remember jobs are a derived demand, they're not going to fall by that much either. So what about an ad valorem tax? Well, the basic analysis is pretty much the same, except that with an ad valorem tax, ST diverges away from S, and the reason for that is that it's a percentage, and a percentage of a large amount of money, say let's say that the price is £5 and VAT is 20%, it's going to be £1. If the price is £1, then it's only going to be 20p. So the gaps between the two lines are going to gradually get bigger the higher the price. Apart from that, the rest of the analysis is exactly the same. There's a consumer burden, there's a producer burden, and who pays it depends upon the elasticity of demand. And that is all I want to say about indirect taxes.